Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. So welcome to the Investing the Templeton Way podcast. I'm your host, Lauren Templeton, and I have a great guest today here with me. His name is Dr. George Athanassakos. I think I've had the most anxiety about pronouncing your last name. Say it for me, George.
No, thank you very much for saying my name right.
Oh, good. Well, Dr. Athanassakos is a professor of finance and the Ben Graham Chair in Value Investing at the Ivy Business School, which he joined in July 2004. He's also the founder and managing director of the Ben Graham Center for Value Investing, which he launched in 2006. And he is the founder and managing director of the Center for the Advancement of Value Investing Education, which he launched in 2008. Dr. Athanassakos has also written articles for the Financial Post. He currently writes as a guest columnist about investments and economic and financial topics in the Globe and Mail, Canada's largest daily newspaper. And he has a new book out, which we will talk about today, called Value Investing from Theory to Practice. So welcome, Dr. Athanassakos.
Thank you, and Happy New Year.
Happy New Year to you. So I want to start with a few questions about your background. I know that you grew up in Greece and you actually started your career in Greece. Can you tell me a little bit about your childhood?
Yes, I think, from young age, I had an interest in business. I remember when I was 7 or 8 years old, I put together a puppet-like show for my classmates, and if they wouldn't pay me, I wouldn't allow them to come in. and then I would, after the end of the show, I would go into the washroom and count my profits. I think I got this interest from my maternal grandfather, who was an entrepreneur in the carpet business in Greece. And then later on, when I went to university, I started my own business in the construction business. I was supplying construction materials to independent contractors. I also tried to import tea and spices from India, but I didn't do it eventually.
Yeah.
I didn't, like financial markets, I was curious, but I did not have any skills at the time. And the Greek market was also very liquid, controlled by a number of families, no transparency, governance issues. So I thought it was more like a casino environment. So I didn't really do much at that time in financial markets. Even at the university, I took a business and economics degree, but it was mostly economics with some marketing to make it look like business. It was only when I came to Canada and I did my MBA and the PhD in finance that the whole thing of finance and investments fascinated me. And when I started working and I'm making some money, I started to study and explore the financial markets and investing. But again, I thought I had the right character, I think, for an investor. Like I was patient, disciplined, long-term perspective. But I did not have a process. And the problem is that at the university, at the graduate program, we never taught about value investing. In fact, I had never heard the words value investing at the university. Mm-hmm. And because, as you know, academics believe markets are efficient, believe that we're all rational. They believe that actually stock picking is a wasted effort as well as due diligence. So I knew nothing about value investing. A big milestone in my life was when I met Prem Watsa in 2004, who introduced me to value investors, and other value investors, and talking to them and to Prem, I started to learn and understand the process. So I became an investor with the process. And I always say that, value investing and stock picking works if you have the right process and the right temperament. So, and I think this has served me very well since then.
Yeah, well, so many value investors find their way to value investing through Ben Graham. It's interesting that you were introduced through Prem Watsa, who, of course, is a legendary CEO of Fairfax Financial. He's known as the Warren Buffett of the North. And for full disclosure, I am an independent director of Fairfax Financial and Fairfax India. Can you tell me about meeting Prem and your relationship with Prem? What attracted you to the value investing process? How did he inspire that?
He wanted to give money to the university to endow a chair at the Ivy Business School. And he wanted to do this because Prem graduated with an MBA from Ivy Business School. So the university put out an advertising for this chair. They brought in a number of academics from Canada and the US, including some of my colleagues here, and me as well. Prem seemed to want to keep seeing me. And the first time we met, he asked me whether I believe markets were efficient. The second time we met...
And what'd you say?
Well, I said I didn't think, because a lot of my academic work actually was based on showing and proving that markets were not efficient. So I made reference to all my articles that I had written about this, and he liked this, because I know from what he told me that there was a couple of academics who tried to convince Prem that markets were efficient. And Prem got really upset because he said, I'm the proof that markets are not efficient. Mm-hmm. And so he was happy to hear my view on this. And then the second time we met, he asked me more about my book. I had written a book then which was called Equity Valuation. And he asked me what I thought about betas and some other metrics that academics like to use. So he asked me to bring him a copy of my book, Equity Valuation, which actually, even though I didn't know anything about value investing, this book, Equity Valuation, was all about due diligence and fundamental analysis. Mm-hmm. So he liked the book. And then he asked me back the third time. So I go into the boardroom, and he comes to me and gives me a big hug. And he says to me, George, where have you been? That was really, because at the time, many people thought Prem was aloof. Prem was a very private person. He didn't want to really talk a lot about the company and what he was doing. But I found him very warm, very sincere, very straightforward. I even saw, actually, in the boardroom, copies of checks, of $1 million checks that he had done business with. And he says to me, George, my handshake is my signature. I don't need to sign anything. I handshake, and my word is my signature. And this really impressed me. He's such a kind and low-profile individual, Mm-hmm.
He's a very friendly, humble leader at Fairfax Financial. And the culture there is very pervasive. I think he does an amazing job setting the tone of the culture at the company. Mm-hmm. It's very strong culture.
And he's making big investments in Greece. And in Greece, people are very formal. Like everybody wants to call you Dr. Athanassakos or Mr. Prem and Mr. Watsa. And Prem says, forget the Mr. and the Doctor, just call me George or call me Prem. And the Greeks are really wondering, what the heck is going on here? And as you know, I was so happy this year to eventually see that Fairfax has outperformed the market by 50%.
Yeah. 2022 was a good year for Fairfax. So yes, we were glad to hold it in our portfolio. We're, of course, long-term investors in both Fairfax Financial and Fairfax India. Well, I've noted in one of your previous interviews that you think this might be a new golden age for value investing. which is very exciting to value investors who have faced decades of underperformance. Can you expand on that a little bit and tell me why you think we might be in a new golden age for value investing?
Yes, of course. I've written about this in my book as well. I think, people say value is back. I mean, I don't think value is back. And the value never actually left because you look at very, very long time periods, value has definitely outperformed. But let me give you my views about this question. I know Sir John Templeton had said that the 4 most dangerous words in the world are "this time is different."
Yes.
But I do think, in my opinion, this time will be different. The next 30 years, 40 years will be different from the last 30, 40 years. And I'll give you my thinking about this. The last 30 years were a period of globalization. Globalization shrank the markets, allowed the free movement of people, capital, ideas. Many jobs from North American economies and world economies moved to the low wage environment of China and India. As a result, in North America, wages stagnated or even fell. Union power went down. They lost, I guess, bargaining power, the unions. Mm-hmm. At the same time, over this period, taxes kept going down. The combination now of lower taxes and stagnant wages or lower wages led to lower inflation and also low interest rates. At the same time, these two events increased profit margin for companies. If you look at the S&P 500, the margins went from 6% in 2000 to 10% in 2019. So the combination of higher margins and lower interest rates boosted stock prices, especially benefited growth stocks, who benefit a lot from low interest rates as you present value the high growth opportunities, and at zero interest rates, and you get really very high current values.
Yes.
Now, what happens next, though? This is past, okay? So what happens next? And this is where my thesis, I guess, comes from. I think we're at the end of globalization. I think we're now in big globalization. COVID increased protectionism, nationalism, also created supply chain problems. Also, security issues became very important. And finally, wars, normally in the past, ended previous globalizations. So I think the war in Ukraine may be auguring a new Cold War and will further challenge globalization. If you look at surveys, I saw a survey by Gartner who showed that 35% of companies surveyed had already moved production in North America. Mm-hmm. Biden, as you know in one of his speeches, he actually encouraged North American companies to bring more production in North America. Mm-hmm. What this creates is excess demand for labor now in North America at a time when the supply of labor has been reduced, either because many people died during the pandemic, also because baby boomers are retiring.
Yeah.
And baby boomers are retiring at increasing numbers, and these are the most productive people, and the ones who replace them are not so productive. So we've got now demand increasing, supply of labor is decreasing, and what we see? We see higher wages, we see unions now regaining power, and we see unions now have settlements that are the highest the last 15 years. Then we have also higher taxes. And taxes will keep going higher because, as you know, pandemic was like a war. The people said pandemic was a war. And the pandemic, like past world wars, were very expensive. And I think same as in the past 2 wars, would require high taxes to deal with the deficits and accumulated debts. I don't know if you know, but after the Second World War, the marginal tax rate in the U.S. went to 95%. 95% just to finance the deficits and reduce debts issued during the war. So I don't think they're going to go to 94%. I think, but they're going to keep going up just to finance the deficits. And finally, the other negative I see is that years of underinvestment in the oil and gas industry and heavy regulation and the fear, I guess, of ESG regulation has shifted the oil dynamics, not only the oil dynamics, but also all the commodities dynamics. And for example, many mining companies are rather than make investments, they are paying more dividends and buy back shares of the fear of ESG regulation. Mm-hmm. So this will again reduce supply of commodities at a time when demand may be increasing because of renewable energy of electric vehicle production. Now, all these events will lead to higher inflation than the last 30 years. Higher inflation means higher interest rates. At the same time, margins will go down. Mm-hmm. So if you think now higher interest rates and lower margins, what's going to happen? How challenging this will be to stock prices, especially stock prices of the growth companies. I'll give you some statistics from some research I did. If you look between 1930 and 2020, 90 years, there are 9 10-year periods. The 3 10-year periods with the highest inflation were 40-50, 70-80, 80-90. In these 3 10-year periods, the value premium, that is value minus growth, was 7.56, 9.96, 14%. Very high value premium. If you look at the 3 lowest 10-year periods, 30-40, 50-60, 10-20, the value premium was minus 2.1, 2, and minus 3 value premium. Mm-hmm. So definitely, as you see, low inflation is bad for growth stocks and good for value stocks. In the Cold War years, which may be going, I think, in Cold War years too here, in the Cold War years, between 66 and 91, inflation averaged 4.3%. The value premium was 10.5%. Value minus growth, 10.5%. In the globalization years, 2008, 2020, inflation was 1.7%. The value premium was minus 4.2. So why I think we're in a golden period of value investing is because I think we're going into a period of higher inflation, higher interest rates, lower margins, and this will help a lot the growth stocks. And so the value premium, even if value stocks don't do so well, the growth stock will do so badly that the value premium will be very high.
Mm-hmm. Yeah, it's a very interesting investment thesis with profound implications for investors going forward. So the basic idea is that we're in a long-term secular trend of deglobalization. You're going to have a loss of worker productivity due to aging demographics and a younger workforce coming in with less experience, higher compensation demands. All of this taken together should produce higher inflation over a sustained period. Also couple that with higher interest rates. So let me ask you, because I do happen to agree with you, but let me push on the thesis just a little bit. So how should we think about growth in productivity as a result of technological advances, AI and things like that? Wouldn't that be disinflationary?
I think there will be some benefits from there. And I understand in North America now, because the supply of labor has been reduced, there's an increase in robotics, or robotics orders actually are going up pretty much. So, I do agree with you that there's going to be some benefit from machinization, I guess, or robotization. But I think the other 2 trends are going to be so overwhelming that, so I don't think we're going to go to the interest rate of 1980. Okay? We're not going to go to inflation of 12% or interest rate 20%. But I think an inflation of 4% going forward, 4 to 5%, is very feasible.
Right. Well, I do agree with you on your outlook. Recently I had a guest on the podcast named Perth Toll, and Perth has some, and she's created an ETF, and she believes in freedom weighting and looking at different countries, avoiding autocracies, et cetera. So with this trend towards deglobalization, how does this factor into your investment selection? It suggests that macroeconomic factors matter more going forward. How should we think about this as value investors who typically are very bottoms up?
Yeah, I mean, I like to say that I invest bottom up, but I worry top down.
Yeah, that's a good one.
I mean, I think the 10 or 11% nominal or 7-6% real returns that we experienced the last 30 years are not going to come back. Okay, the going forward returns of the market will be much lower than that. This doesn't mean that you cannot find individual stocks. That's why I think we're back to the stock picking and fundamental analysis becoming very important again. So, I mean, personally, I would invest in this environment. I would invest in good quality stocks that pay dividends, and I will focus a lot in value stocks.
Mm-hmm. And when you're thinking about stocks globally, how do you factor in these macroeconomic factors when you're doing country analysis? Do you just change your discount rate, or how do you factor in the risk of deploying capital?
The cash flows, I guess, are affected as well as the discount rate. I think actually I gave an interview to a Greek website, and they asked me about what I thought about the environment in Greece. I said, look, when you have an environment with economic instability, a lot of demonstrations, regional stability, what happens is this affects your ability to forecast the cash flows, but also affects the discount rate. So you got to put a premium to the discount rate, and when you discount at the high discount rate, mm-hmm. what happens is your present values are lower, and many projects are no go. Mm-hmm. So in many countries with economic instability and also regional instability, like Middle East, Northern Africa, and Greece, I guess Eastern Europe, a lot of value destruction has happened because of the discount rate being affected, and so mm-hmm. when you use a high discount rate, you have lower values, and investors don't want to invest in there because they're going to destroy value for them.
Yeah.
So yes, I do incorporate, especially for markets with governance and liquidity issues and transparency issues, you've got to use a high discount rate.
Yeah. Yeah. No, I love that saying that you invest bottoms up, but worry top down. It reminds me so much of my uncle, John Templeton. He was very bottoms up. As you know, he ran a lot of screens before the days of Excel and Bloomberg downloads. He was doing it by hand, but he did avoid countries trending towards socialism, and he wanted to invest in countries that were continuing to open up and become freer. And he was a big advocate of individual freedom and free markets. So, of course, a value investor can incorporate and adjust for the risk in countries with the discount rate for sure. But it does seem like we're moving into an environment where value investors need to be really aware of macroeconomic factors.
Of course. And I mean, you saw what happened to China, right? Mm-hmm. A lot of value distraction because of the Chinese autocratic system.
Yes.
And you got autocratic systems in Turkey, and of course in Russia. Yeah, you want to avoid these countries, and because not only because the autocracy, but also mm-hmm. because there's no transparency. I remember I valued a company. Some students actually did a project on a Chinese company, mm-hmm. and I looked at the financials and said, I don't understand what the heck is going on. I cannot really put the numbers in a balance. And 3 months later, I found out that there was a big lawsuit because the guy was cooking the numbers.
Yeah.
So you know, you have a compounded problem with autocracy, less democratic system, and less transparency and governance and controls.
Mm-hmm. Yeah, it's risky for sure. In your new book, Value Investing from Theory to Practice, I don't know if this is in your book, but you talk about how you've developed 5 questions to determine if you're a value investor. Can you share those questions with us?
I interviewed about 19 value investors.
Uh-huh.
Out of the interview, I summarized, I guess, their views into 5 questions. And so I know one of them was, do you buy a new car every few years? Mm-hmm. And of course, value investors say no, because buying a new car every few years, you lose a lot of money, a lot of value.
Sure, yeah, the depreciating asset.
Yeah, exactly. So that was if you say yes, you're not a value investor. You say no, it's a good check mark. Also, another question was, are you a low key? Mm-hmm. Not necessarily antisocial, but certainly asocial. Value investors are, many of them are shy or humble, are not too social, not the party animals. They don't like too much gathering. That's why you see, Buffett living in Omaha, and other many good value investors do not really live in metropolitan cities, because there's a lot of noise there. A lot of noise, a lot of cocktail parties, and the more you interact, you're human, you are affected. Yes. Your judgment is affected. So I think, and actually many people have emailed me and said, George, my partner is like this. He's not antisocial, but he's asocial. Mm-hmm. The other was, would you like to buy a stock that has fallen to a 50-year low? I remember Walter Schloss. He would buy all the 52-week low stocks. Now, at the time, I guess, he would try to diversify some of the risk by buying all of the low 52-year lows. But, in my mind, I guess you don't want to buy all low 52-year lows. You want to do some due diligence and some valuation to make sure that you don't buy really bad stocks.
Yeah.
And that's why, I think when people talk about value investing is not like low PE stocks. Value investing is good low PE stocks.
Yeah.
So when you screen and you find the low PE stocks, a stock can have low PE because simply it's a bad stock. The question is, how can you separate the good low PE from the bad low PE? Then you do the second step, which is valuation. You value to find the intrinsic value. And then, if you got margin of safety, you buy. If you don't buy.
Right. That's how it's supposed to work.
So another question, do you think that high IQ is the key to investment success? Buffett says that what we do is simple but not easy.
True.
If you got an IQ of 150, he says, sell 30 points, somebody else, you don't need it. Because he says, successful people are intelligent, but intelligence has nothing to do with success. It's more a frame of mind or make decisions.
Yeah.
Understanding human weaknesses and institutional biases.
Mm-hmm. True.
Do you think, and I think that was the last question, do you think there's a formula to achieve good investment results? I don't think there's a formula. And if you look at The Intelligent Investor, it's a book not about formulas, it's about processes, how to think about investing. Have to have the right process, the right analysis. So they're not actually formulas. And that's a problem with academic finance. They think everything is formulas. Because what I say to my students is that what we do is not deterministic. It's not like physics or math. It's an art. Because financial markets are not natural phenomena. They're man-made. Made by men and women who, in their effort to control risk, affect risk itself. Mm-hmm. And so, if you think that formulas are important, it's going to be really bad for your wealth because, and I've seen recent papers by physicists who said physics envy has created a lot of false precision in investments and can be really bad for your wealth.
Yeah, sure. Well, I've passed the value investor test. I think I got all the questions right. I'm definitely a value investor. The other day I was working out and my trainer looked at my car and I said something about somebody had a nicer car. She goes, everybody has a nicer car than you do, Lauren. Well, I know you have spent a lot of time with successful value investors, and you are so gracious to invite many of us to speak at your conference every year that occurs around the same time as the Fairfax Financial AGM. You may have noticed that all of us are similar, but we definitely differ in many aspects. What have you learned about the similarities and differences between well-known value investors, and what really stands out to you?
Well, it seems to me that most value investors have common characteristics. That is, they are patient, they're disciplined, they're long-term. That's why I think value investing is a profession, whereas money management is a business. I'm sure there are small differences, but the core values are the same. And this is what makes, in my mind, value investing a profession.
Mm-hmm. I agree. I mean, particularly talking about the long-term time horizon, I find that I'm often at odds with many people on decisions because I'm just so focused on the long term. It can create a very different outlook when you're focused on the long term. And John Templeton was one of the most challenging people to talk to when we're referencing time horizons, because he would often say to me that he was evaluating the best investments for his foundations over the next 200 years. And so he really challenged that definition of long-term time horizon. I mean, I think I naturally think out 10 to 20 years, but he was trying to think out 100, 200 years. So definitely had a unique perspective there.
But the other, I guess, the one problem is for value investors managing the clients. Because you may have a long-term perspective, but your clients may not.
Correct.
So I think value investors have to train the clients. In fact, I thought value investors were the only money managers who have fired clients because they couldn't really listen to them.
No.
Or question them all the time.
Yeah, it's true. You've got to find the right fit and make sure that the client doesn't only believe your philosophy, but really can execute it. I always tell individuals that you're a partner with your investment manager. Mm-hmm. You can hire one of the best investment managers in the world that produces a great track record, but if you're constantly sending capital at the wrong time and taking it away when the manager pulls down, you're going to have really bad returns. So it is a partnership. It's not completely your investment manager's fault what the track record is of your personal account. It depends a lot on timing and your own behavior. So you've got to find a good investment philosophy that matches your own temperament and make sure that you're aligned with your manager. It's very important. Well, tell me about your new book. What inspired you to write it? What is it about? And what do you hope to accomplish with it?
Yeah, so the book is a comprehensive book of fundamental analysis. It follows a holistic approach to valuation that brings together finance, accounting, strategy, economics, and psychology. It's very different from the typical modern portfolio theory approach taken by academic investment books that use formulas, techniques, and a quantitative approach, trying to cut corners to fundamental analysis and believing that markets are efficient and that due diligence is a wasted effort. My book is unique, not only because it focuses on fundamental analysis, but because it also links to a web-based valuation model and online applications to real-life, real-time companies that make the book come alive. Now, why did I do it? As I mentioned before, academics believe markets are efficient, believe that we're all rational, that is, we're all these dispassionate calculating machines that collect information, judge them, and weigh them, and then make the right decision. In real life, this is very unrealistic, and there's a lot of evidence by psychologists that we're not really rational. Mm-hmm. So as a result, there's not really an academic book in value investing. Academics never learn about value investing, so when a young faculty wants to teach value investing, they have no book to base their lectures on, and so they're discouraged from putting together a proposal for a value investing course. So my hope is this book will be a stepping stone to facilitate the adoption of university-level value investing courses around the globe. I know, and you know probably that Buffett and Munger and Klarman and others have mocked what is taught in finance departments at universities, and I think my book will make them very happy, actually.
Well, congratulations. That is a huge feat, and I'm sure that it will be used by students everywhere. It's wonderful that there's an academic book on value investing methodology.
And I want also to stress that, people say, oh, there's so many value investing books out there. But, all these books are written by professionals who give readers their own story subjectively in a narrative way. There are no academic books that provide a rigorous and objective structure. Mm-hmm. It's a book that goes from the beginning of value investing to the end. Prem Watsa called it the New Testament. And it's the only book that discusses the theory of value investing, and links it to academic valuation, explains what we do in value investing, and puts theory into practice. The approach I take also is that we better be approximately right than precisely wrong. And this again goes against modern portfolio theory that uses formulas and believing and aiming for precision, which in real life is very unrealistic.
Mm-hmm. Well, we will make sure and have links to the book in our show notes available on the website for everyone who's interested in obtaining a copy. George, I know you also write for the Globe and Mail, and I've read a recent article about the January effect that you authored. Can you please describe for listeners what the January effect is and why we may not see it this year?
Academics around the world have shown that statistically, the January returns, especially for riskier stocks, are much higher than the other months of the year. So there's no real doubt about this. The only problem is that this is an average effect. It doesn't mean it happens every year. Mm-hmm. So in my research, I try first of all to understand why it happens and what causes it. And what I think, in my opinion, causes this is portfolio rebalancing by professional portfolio managers who, in January, they rebalance the portfolio with an aim to get their Christmas bonus. So they say, what should I do to outperform my benchmark? And they say, well, maybe I should take more risk than my benchmark. So what we observe is the herd of professional portfolio managers invest in riskier securities in January. Because the herd goes at the same time, we see a strong performance of riskier stocks in January. Throughout the year, as they realize a return that may give them the Christmas bonus, they slowly get out of these riskier positions and they go back on the benchmark, or they go to safer securities, even government bonds, and by doing this, they lock in the Christmas bonus. Mm-hmm. Now, so I said, this makes sense. And if you look at the investments, I guess, if you look at flow of funds in the stock market, are very strong in the first quarter of the year and weaker the rest of the year. The opposite happens for government bonds. Government bonds tend to be weak in January, government bond returns. Weak in January on average and stronger towards the end of the year. Mm-hmm. And this is what you expect. If they go into risk in January and out of riskless, they benefit the risky and they suppress the riskless. When they rebalance out of risky toward the end of the year into riskless, they benefit the riskless and they hurt the risky securities. But what I argue then in the article is, do they always go in January heavily in the riskier stocks? And I don't think so. They go in January into riskier stocks when they think the year ahead will be good, mm-hmm. like a a recovery or a bull market. They don't go indiscriminately into riskier stocks. So I try to figure out, can I find some indicators that give me a sense of how portfolio managers think? So I looked at 4 indicators. That the 2 were strongest. One was the yield curve, and the other was profit expectations. So positively sloped yield curve is good, and also increasing profits expectations is also good. But what happens, I guess, and this from quarter to quarter. So what happened the last quarter is we saw the yield curve becoming more negatively sloped,
right,
and we see profit expectations declining. So I said, if historically this led to bad Januaries because professional managers tend to not be willing to invest in the stock market because of these expectations, then I said, since these 2 metrics point to reduced incentive by professionals to invest in the stock market, this may be negative for stocks in January.
Yeah. So, and the saying is, so goes January, so goes the year. So if we don't see the January effect though this year, is that good for value investors?
Again, these are average effects, right?
Yeah.
I think in any market you can still find good stocks if you do a fundamental analysis, bottom-up stock picking analysis.
Sure. Yeah. We always say the same thing.
I think ETFs were the way to go the last 30 years. The next 30 years will not be ETFs anymore, will be stock picking.
Yeah. Hopefully. Right? My job is dependent on that. So you've also written quite a good bit about corporate governance and the trend towards cookie cutter approaches to corporate governance that come along with this ESG culture. When you were looking at corporate governance, what are you focused on? And are there certain metrics or attributes that you like to look at?
Well, I want to see friendly management to the shareholders. I like good managers. I like managers who manage the asset and liabilities well, who tell you exactly what they do. They don't really hide numbers from you. Mm-hmm. Managers who are really taking seriously questions and suggestions by shareholders.
What about board structure? What do you look at? Is there anything you look at or want to see in terms of board structure or even capital allocation practices?
Well, capital allocation is key in my mind for CEOs. CEOs play 2 roles. One is operator and the other is capital allocator. Most CEOs are good operators because they learn the skill through going up the various positions in the company, but they are not really good capital allocators. And as Buffett says, capital allocation is the most important role of a CEO.
Sure, you can destroy some shareholder value if you're not careful.
So what am I looking for? Am I looking at CEOs who, if they buy other companies, they buy at low PEs? I look at CEOs who, when they buy back shares, they don't buy them at the peak of the market. They buy them when the P is low. Even when they buy for their own account, insider trading, insider buying, I guess, I want them to buy at low Ps. I don't want them to buy at high Ps. I'm writing actually a paper the last year. The question of the paper is, do value investor CEOs outperform? Mm. So we're trying to figure out a metric that will show that the CEO behaves like a value investor. I'm going to look eventually at some other metrics, but the first metric I looked at was goodwill to assets. So I said, if a company has high goodwill to assets, which remains high for the next 5 years, at the same time that operating margin is high, this means that the CEO made good acquisitions, because if they did not, they had to write down goodwill, so they did not write down goodwill. They made good acquisitions, but also made sure that the synergies were achieved, and so that the operating margin stay high. And I compare companies with high and steady goodwill and high operating margins with companies the high goodwill to assets which went down and falling operating margins. And I found over a 3-year period, what I call the value investor CEOs outperform the not so good value investor CEOs by about 33%. And interesting enough, when I printed out the companies that were having good value investor CEOs, my sample was about 80% the same as the sample Lawrence Cunningham, who looks at quality shareholders.
Yeah.
So basically, quality CEOs attract quality shareholders.
Yeah. Lawrence Cunningham will be a guest on the podcast later. So you're in good company there. Well, how important do you think corporate culture is, George? Is it important at all? And how do you determine it as an investor? Just an investor sitting at home, reading the reports. How do you determine corporate culture or place a value on it?
That's a tough question. I mean, I know for a fact that differences in corporate culture make acquisitions a failure. That is, 5 out of 6 acquisitions failed because the corporate culture cannot really mesh between these two companies. So how do I find corporate culture? Again, I mean, I look at how CEOs behave. Are they respectful to their employees? Are they respectful to their shareholders? Do they use aggressive or intimidating language? Do they answer the questions calmly without really trying to avoid questions during the interviews by reporters? And I like actually to hear CEOs answering questions that did not know in the first place, because most of the time, I guess, when they prepare statements, they're all prepared, I guess, by lawyers or whatever. How do they answer the questions when analysts ask them questions out of the blue?
Yeah.
And many times, also you want to see, do they have an ego? Like, do they want to be the biggest of the biggest in their area? So I need to understand also that they understand the business and the industry very well. And they don't want to go into areas where they don't have competitive advantage or where they're going to be in a competitive disadvantage position. So there are many things you look at, and management, of course, is very important. Management, always, I tell my students to have a management discussion. How old they are, what their background is, what their education, their experience. Do they understand the industry? Do they understand the business? Do they hold a lot of cash that's sitting there doing nothing? So there are many, and also what I do, I like to listen to interviews that they give, written or oral, because they tell you a lot about who they are.
I love to listen to the analyst calls.
Yeah, absolutely. They tell you a lot about the management because they have not prepared these answers. So they've got to think on the spot there. And if you're a bad character, actually, many times you slip.
And you can hear a lot in the tone of their voice, the stress or the ease in which they answer the question, the humility that they may have when they're deferring to somebody else in their team, how often they credit others on their team for successes, I think are all really indicative of what the corporate culture is. I always placed a high degree of value on corporate culture. And then I went on the Fairfax board and I saw, wow, this is a company with a very strong corporate culture. And it's really pervasive across the board, management, the headquarters of Fairfax. It's all singing the same song, and I think it really affects the company for sure. What is your take on ESG?
I don't know. I mean, I think it's just a fad. It's going to go away. I mean, ESG has hurt oil and gas, and we're seeing the effect on oil prices. And I think oil prices will remain higher than historically because of ESG. Of course, the environment is important, and I think many CEOs get this. We don't have really to make their life difficult, because we make the life difficult for the CEOs. We make the life difficult for money managers. So I think they get it. Governance is important. I think boards have to be representative of the society, and so I don't understand what's the whole thing about. And sometimes I think it's like a scam or something. I don't know.
Yeah, the greenwashing they call it. The energy that ESG in respect to energy is so interesting to me because of the fear of regulation. There hasn't been a lot of reinvestment into that industry, and oil prices are very high, and ESG investors have actually been penalized in the past year for not investing in energy.
Yeah.
It's I'm curious what all the endowments and institutional investors who have adopted these ESG investment mandates think when their returns haven't kept pace with the market due to their lack of exposure to the energy industry. It's going to be interesting to see how it all washes out.
There's no evidence actually that these stocks do well. The ESG, I guess, stocks do well, better. I mean, there's no statistical difference. So yes, I think it's a fad. It's gonna pass. But a lot of ETFs made a lot of money out of it. A lot of money managers made that, because these were the fastest growing ETFs were the ESG.
Yes.
ESG ETFs.
Yeah, there's been a lot of flow into ESG investments over the years. So I also think it's a bit faddish. I think there are facets of it that will stay and remain very important, but it has a long way to go. And of course, right now it's just about reporting, and the standards are so different. But I'm very tempted to ask you, since you're from Greece, what are your current thoughts on the investment environment in Greece or Europe?
Well, I mean, Greece is going through an election in a few months. Greece needs definitely a business-friendly government, and I worry about what's going to happen to Greece, because the socialists or the left wing parties getting power, and if these guys get elected, this is going to be the end of Greece. I mean, it's just. I hope the Greeks make the right decision. Of course, we all know the problems with Germany and the dependence on Russia, oil and gas. I think Europe definitely is going to go through a recession this year because of all these problems they had. I mean, in Greece, electricity is going up like crazy. I mean, again, I'm not really very excited about the Greek market, but again, there are some very good quality stocks in Greece that one can find. Now, of course, the other issue is have investors being extremely negative on Europe, which may give opportunities, I guess, to some European. And there are many good German companies, Holland companies that are in the forefront of technology and ideas, and they will do very well. Again, I don't think everywhere, not only in Europe, I don't think we're going to be in an environment where the market as a whole will do well. I think it's a market for stock pickers. Yeah.
Well, there are a lot of inexpensive stocks in Europe right now. Certainly, I think there's a lot of opportunity there for people who are good stock pickers. You often talk, George, about the parallels between value investing and a well-balanced life. Can you expand on this just a bit for me?
Yeah, when you have a passion about investing, and the passion is synced with your personality, you're going to go to work, as Buffett says, tap dancing. You never want to retire. So what I say to people, is that you've got to make sure you got the right temperament for investing. And, when you're patient, you're disciplined, you have long-term perspective, these are traits that define your character. And this character will lead you to good investment performance, but also a more balanced life. Because if you don't care about the day-to-day volatility, you're more relaxed about life. Mm-hmm. And this tends to, that's why, many value investors tend to live long. A best example is Irving Kahn, who died at 107, and up to 105, he was talking to me about what stocks would be good in Canada to buy. Walter Schloss, he died in 96, I believe.
Mm-hmm.
As you know, Buffett and Munger are over 90.
Mm-hmm. John Templeton was 96 when he died.
John Templeton, yeah. Mm-hmm. Many of the longest investors of Berkshire were all in the 90s. So it seems, I guess, the value investor characteristics mm-hmm. help you live long.
Yeah, definitely a well-balanced life. I mean, I get a lot out of networking in the value investor community. I find that most value investors are humble. They're savers, and, realize that there's a lot of risk in the market. So they're savers. They're not watching the market every day. So mm-hmm. The ups and downs of their portfolio tend not to affect them very much. They're really curious and lifelong learners, and all of that makes for a pretty healthy, well-balanced life. So I do think you're right on that. What is your best advice for young people? I'm assuming, surrounded by young people every day at the university. What is your best advice for them?
I think I tell them not to be afraid to try different jobs mm-hmm. and experiment on what they may like doing. Life is too short to spend doing something you don't enjoy. And life follows a non-linear, dynamic path. There are many unknowns. I think only few people know from day one what they want to do and what their true passion is. And normally you find your true passion sometimes by trial and error. And as I said before, what is your passion has to be consistent with your personality. If these two are in agreement, you're going to do very well in life, but also in investing, but also in life.
Yeah, it's really good advice. I have similar advice to young people. Just, not try many things. You don't have to love your first job. You probably won't. It's probably better that you don't. Mm-hmm. Find out exactly. What you don't want to do first. That's all very helpful information. This idea that they have to step out of university and immediately fall into their lifelong passion is a lot of pressure. And I think it's more healthy to end up in a position where you're like, I know I don't want to do that. So,
yeah, and don't let your parents push you in something you don't want to do.
Well, that is true. My, the Templeton Foundation's award every year, the Templeton Prize, and Jane Goodall won it a few years ago. My daughters and I had the opportunity to go to California to meet Jane Goodall this fall, and my oldest daughter was given the opportunity to ask her a question. So she said, Ms. Goodall, I really want to be a marine biologist. What is your advice to me? And her advice was basically, let yourself change your mind. Fine, try it, but you might mm-hmm. not like it. Mm-hmm. And if you don't like it, that's okay. Move on and try something else. So I agree. I think changing your mind, trying lots of things until you find something you love is pretty good advice for young people. Well, my last question for you is a very easy one. Where can people go to learn more about your work?
Well, they look at the bengraminvesting.ca website, where they can find some of the papers I write, academic papers. They can find a lot of the articles I write for the Globe and Mail, the Financial Post, the Canadian Investment Review, the Money Sense magazine. And most importantly, I think, they should buy my book. And second, they should take my seminar, which I offer every year in the summer. It's a 5-day seminar that I teach. And many times I invite also some guest speakers to talk about how they put theory into practice. I offer it in the summer. This year will be offered May 29th to June the 2nd.
Okay, great.
And I offer this in Toronto. I teach this course over 5 days. The last 3 days, I have breakout groups where I invite my MBA students to tutor the participants. They go over some of the valuations we do. They come back. We take up the valuations and we answer more questions to the students. And then got a reception and we're all happy.
Yeah, that sounds good.
And they can go on the Ben Graham website, and they can see information about the seminars, and they can see testimonials from all my students who take this seminar. The seminar is geared not only to professionals, but also to individual investors who want to take their own control of their own investing. And many times I see parents who come with their young sons or daughters to take the seminar. And normally the young sons and daughters are better than the parents eventually.
Isn't that always the case?
Yeah.
I would be remiss if I didn't tell listeners that every year I try to attend what Bob Robotti, who is a well-known investor, refers to as the Triple Crown of AGMs. That is Fairfax Financial, Berkshire Hathaway, and Markel. So last year I attended all three meetings: Fairfax Financial, which is in Toronto, Markel in Richmond, Virginia, and Berkshire Hathaway, which is in Omaha, Nebraska. But one of the very neat things about attending these events, of course, are all the people you get to meet. But George actually holds a conference at the same time as the Fairfax Financial AGM on value investing. And you often have amazing speakers speak at that conference. I've spoken there, and it's been virtual the past 2 years. Do you plan to have it in person?
Yeah. So it's actually one day before the AGM. And this time will be live for the first time in the last 3 years.
Yay.
And as I say, value is back. And so is our conference. Keynote speaker, Howard Marks, will be there. And also we have as a speaker, the CEO of Occidental.
Oh, okay.
And also have another keynote speaker who's going to speak about fundamental analysis and what his company does in this front. And then we've got 6 value investors as well that they speak.
Awesome. Well, I encourage everybody to sign up for that conference, and they can do so by going to the website you mentioned, which again is
bengrahaminvesting.ca.
Yeah, bengrahaminvesting.ca. We'll have the link in the show notes. I would highly encourage everybody to buy Dr. Athanassakos' book, sign up for the conference, and then come join a great group of value investors at the Fairfax AGM in Toronto. You will learn a lot from a very humble CEO, Prem Watsa, and then you can follow the group on to Omaha and then later to Richmond if you choose to do so. It's a great place to network and make friends. Dr. Athanassakos, I appreciate your time today. This has been an excellent interview, and thanks for coming on the Investing the Templeton Way podcast.
Can I leave you with one motto?
Always.
This is not my motto. It's something that Aristotle said many years ago. And I love this sentence. He said, the aim of the wise is not to secure pleasure, but to avoid pain.
It's a great quote. And thank you so much for sharing it. We'll have all that information listed on the website for listeners, and I look forward to seeing you in April. Thank you for listening to Investing the Templeton Way. Please be sure to subscribe on your favorite podcast player. To view the show notes and resources mentioned in today's show, head to investingthetempletonway.com.